Wow,
all right, thing number 3 this morning. The 10-year Treasury real yield turned positive this morning. That was the first time that has happened since 2020. Joining us with more on what is going on there and why it's important is our Brian Cheung, a host of the 11 a.m. hour and, of course, intrepid Fed reporter. So talk us through what we're talking inflation-adjusted yields here.
Yeah.
Talk to us about why they're important and why we should be watching them.
So I promise our producers we're not going to do a full Yahoo you here, but what we're looking at right now are kind of long-term bond yields. And you notice that's a positive number, right? So what are we talking about when some yields are negative? Well, again, this is what we're looking at. This is what we often quote on the live shows, nominal bond yields as is currently priced. We know the 30-year getting close to 300 basis points. What's interesting is the 10-year note, which is one of the most liquid measures of duration in the Treasury yield, has really gone up pretty markedly over the last 2 months. You would call this something of a Kilimanjaro, hiking the mountain type of formation, right? It's going up. We're getting really close to 3%. Now, why is that happening? It's because we've gotten so much chatter from Fed officials saying we're very intent on raising interest rates farther than the 25 basis points that we began in March. So what does that mean? Could be 8, could be 10 interest rate hikes coming just this year. So the expectation is for this to go even higher because, again, this is a proxy for interest rates in the future. So if the Fed's raising short-term interest rates, these figures are going to go up as well. Now, we have another measure of these types of instruments called the Treasury Inflation Protected Securities, or TIPS. And this is the chart I want to show you now. These are end-of-day figures, so you'll notice it's still in the negative. But on an intraday basis, the 10-year Treasury as inflation index, I can get into the nuance of that later, actually briefly touched positive levels yesterday. And essentially what that means is that when the principal of the bond goes down, the yield is going to go up. Now, these types of securities are ways that investors can bet on future inflation. So if the yield is going up, like we saw in that chart, getting close to 0, or in some cases positive, as was the case briefly yesterday, that shows that they have more anticipation, more confidence that the Fed's going to be able to get a lid on inflation than they did earlier in the year. And why is that? Because, again, the hawkish jawboning that we've gotten from Fed officials over the last few weeks, guys.
Brian, these moves in the bond market, these are big moves. Are they the type of moves that might give the Fed a little pause in terms of how quickly it raises rates?
No, I think, if anything, this is an affirmation, as of yesterday, that the Fed might actually be starting to get a handle on this. Now, it's not just the commentary from the Fed itself. You saw some kind of components of the CPI analysis from the CPI, again, that 8.5% year-over-year figure that we had gotten in the month of March. People saying, well, maybe that's showing signs of a peak. Again, that might be optimism, that might be hope, but at the end of the day, it's possible that that figure could be among the highest that we'll see in this hiking cycle. If that happens, that means the Fed is not necessarily mission accomplished, but at least they're starting to get a grasp on all of this. Now, keep in mind, we're about to get into a bit of a rocky period because the Fed blackout period ahead of the next meeting, which is going to be May 4th, is going to begin next week. So there's going to be no commentary during that period of time. It's going to be a noisy week out of that FOMC meeting. There's going to be a jobs report on the Friday after that. So all of these things could kind of complicate the picture on inflation. But when you're looking at how bond markets and the TIPS markets are pricing in how the Fed is reacting to inflation, it shows, at least for the first time since the end of 2021, it's possible the Fed might be starting to get a grip on this.
Yeah, and, we are going to enter the blackout period, but ahead of it, we've been getting quite a bit of commentary, right? We're going to get more today. Mary Daly, Charles Evans, Raphael Bostic, it looks like all of them are speaking today. Charles Evans, it was interesting, he spoke yesterday. He's not viewed as particularly hawkish, but he said something that was maybe not hawkish, but maybe less dovish than he has been.
For what it's worth, it's a flock of hawks. Everyone's a hawk at this point. Now, the question is, what makes you more aggressive on interest rate hikes than others? And one measure would be the neutral interest rate, right? So neutral interest rate is basically the level of short-term interest rates that the Fed would have to get to where it's neither stimulative nor depressive to the growth of the economy. Right now, we're still well below neutral, so it's still stimulative activity to the economy. Now, the estimates from the Fed itself is that it's somewhere around 3.5%. So we did that little blip in the March meeting to 25 basis points. That's still far away from 3.5%, right? Now, when I look at the 10-year note, 2.9%, you look at the 30-year T-bond, not even at 3% yet. What that tells me is that Fed officials like Charlie Evans yesterday saying, I could see us going past 3.5%, not this year necessarily, perhaps next year. That means that these numbers will continue to go up. And as nominal bond yields go up, that means tips will probably continue to go up. So even though we only saw the brief blip into the positive in 10-year tips yesterday, I would expect that to actually be a trend as nominal yields go back up. Other real yields will probably go positive soon as well.
Brian, you have to send this clip to Mary Daly. I hear you're going to be talking to her.
Who I'll be speaking with. Yeah, actually, I'm going to go to Newark very shortly.
That's not where you're interviewing.
No, that's not. I'm not interviewing now. I'm going to go out to San Francisco, but you'll be able to catch that interview tomorrow on the 11 a.m. program right here on Yahoo Finance.
You don't want to be interviewing anybody in Newark. All right, Brian Cheung, thanks so much.